Hello everybody, and welcome to another video where we are analyzing the financial statements of a company. And today we are going to be looking at quantum computing. So quantum computing, this is what they do. They are a software vendor offering ready-to-run software for complex optimization computations. This is straight from their website. Founded in 2018 by leaders in supercomputing, mathematics, and massively parallel programming to solve the enormous software development challenges inherent within quantum computing. And while the market focuses on the quantum processing unit hardware, our founders realized the traditional SDK approach to quantum software doesn't work for non-quantum experts, given the completely new programming paradigm. So I'm not an expert on this, but it sounds to me like these guys are in the world of big data. So helping companies to crunch, vast amounts of data and make sense of it. That sounds like what they're up to. But if I'm wrong, then please do let me know. So we are looking at this because Matthew Stone asked me to. So he said, could you do a video on quantum computing? It's a very overlooked technology which has big potential of improving the tech of the future. I started investing in this company in the $2, but recently sold 80% of my stocks on the recent big run up a few months ago, and very tempted to get those shares back. So we're going to do some fundamental analysis. Now, a little caveat here, and always the same caveat. We're just looking at the numbers. We're looking at the financial statements. I don't know about the business. I don't know whether it's just signed a deal with a big customer. I get a lot of comments on video saying, oh, Ted, you don't know this and you don't know that. I know I don't know that. I'm admitting that. I am doing the financial analysis. This is called fundamental analysis, and this should be part but not the whole of your research. So don't rely just on what you hear here. You need to do your own homework as well. So without further ado, let's jump in and have a look at quantum computing and look at their financial statements. So here we have their financial statements. This is the Form 10K filed with the Securities and Commission, and we are going to whiz down through all of the information and find ourselves the profit and loss account, which is where we're going to start. So here is the profit and loss account, 12 months ended 2020. It's in dollars, you'll notice, so in absolute dollars, and you'll notice the total revenue is zero. So these guys are not making sales. They are still in the development phase. So total revenue, cost of revenue is zero. There is no gross profit. And so in effect, all of the costs of running the business effectively result in a loss. And you'll notice that from 2019, the loss has increased from $2.5 million to $17.4 million. Now, what's driving that? We've got some SG&A of about $2 million and this stock-based compensation. Now, I'm guessing that that is paid to the employees in order to compensate them, to keep them on board. You'll notice that there's a little bit of consulting. We're bringing in some external consultants and also some R&D, which is kind of investing for the future. But without a doubt, this is the big number, and it would be interesting to know exactly who is being compensated with stock. So if you are a shareholder in this company, the company is effectively issuing shares either to its employees or perhaps its directors, or it may even be to potential customers, but it doesn't look like it has any customers because there is no revenue. And this is diluting you. So this is diluting your shareholding. Now, not a problem if it turns into a unicorn, but you might be a little bit upset with that. Okay, so there's the profit and loss account. We'll just whiz down to the bottom, see if there's anything else that looks funny in there. And what we notice here in the bottom part of the profit and loss account, so below the loss from operations, is there's quite a lot of costs involved here around interest. Okay, so these are various debt instruments which are funding the business. We see things like warrants and promissory notes and etc. etc. So we don't really have to know exactly what they are, but what we do know is that this is a form of kind of debt, or hybrid debt, as we might call it. So it's probably sitting somewhere between debt and equity. Be a very brave lender to lend money to this company. So this will be people who've lent money. It's an easy way of getting it back out again, but they can convert into shares if they have the option. So that's, we can really take all of those numbers together, and we see there's a reasonably large increase in debt. So while this particular number has gone down, the total interest has gone up from 5.8 million to 7.8 million. So that's a significant cost to the business, on top of the 17 million that it's costing it in terms of its operations. So what does that mean for the company? Well, if we scroll down, we can see the bottom line net loss is $25 million compared with the previous year of about $8 million. So these guys are losing money. So let's turn to the balance sheet and look at their financial strength. And the balance sheet, here it is. So we notice for the balance sheet, so really very, very small fixed assets. Okay, so they have really no fixed assets at all. Remember, this is in dollars, this isn't in thousands or millions. So they've got about 31,000 of fixed assets, which will be, computers, basically, a few servers maybe. Lots of cash, so $15 million of cash. The previous year they had about 100,000 worth of cash. So the cash has gone up. They're not making any sales, and therefore we assume, and we'll find out a little bit later if we are correct, but we expect that there's a that they're funding through the issue of shares and the issue of debt. Scroll down to the liabilities. So down here we see the liabilities. Now, total liabilities for the company. So last year, you'll notice total liabilities were about $3 million, and the current liabilities, they don't actually split it out, but I'm going to assume that these kind of loans payable, loans typically long-term funding, that's generally the long-term liability. So this section here is really long-term liabilities. So these are the short-term liabilities. That derivative liability, maybe that's part of the short long-term, and in effect what we see here is that the current assets up here are not sufficient to be able to cover the current liabilities, but it's not a problem because the company went to market, they've raised additional capital, and now they can easily meet their current liabilities at the moment. Okay, so they can meet them at the moment, but they can pay all of their current liabilities at the moment, so that's fine. However, we need to look at their cash burn. So they've got this $15 million in the bank. The question is, how long is that going to last them for? So in order to answer, in fact, we just look at the stockholder, the equity section. Now we notice here, quite interesting, that there's a little bit of loans payable, but there's no kind of promissory notes or no debt sitting on the balance sheet. So what's interesting is that we saw this interest payable in the income statement, but there's no debt associated with that interest in the balance sheet, which means it must be somewhere here in the equity. So that means that this is going to be this kind of somewhere in here there's going to be some some form of hybrid instrument. They're treating it as equity. Maybe they should be treating it as debt, I don't know. And here you've got additional paid in capital, and then you've got some so this is additional paid in capital, that's APIC. Additional paid in capital is just extra money paid in, that's all it means. Beneficial conversion feature in equity. So this is kind of, I can convert it into equity, so it's debt, but it can be converted into equity. And we see some stock-based compensation, and we notice stock-based compensation, pretty big number here. Here's the 15 million, and it was 4 million. So that's the 11 million that we saw in the income statement. So really what stands out for me, and this is just looking at a sort of cursory glance, is that that they're paying a lot of interest, but they don't seem to have any debt that they're paying that interest on, which doesn't really make sense to me. You'll notice here that this promissory note, that effectively they don't have it anymore. So we should be able to get a few answers if we look at the cash flow statement. So let's go and have a look at the cash flow statement, and see what is going on. While we're looking at that, just interesting, just to come back to the income statement as we're going through it, and just notice this interest expense derivatives mark to market. Now, typically, a company like this is going to use derivatives to manage its exposure to interest rate variation. So they'll be buying interest rate swaps in order to manage, if interest rates start bouncing around, they don't want to have to suddenly, fork out a lot of money. What I just noticed here is that the negative, the cost in the previous year, 2019, is exactly the same as the positive in 2020. So it looks to me like this is a kind of, what they've basically done is they've just moved it from one period to the other. And perhaps we can see that. So that 987.30 is actually this number here. So we can see it pops up as a derivative liability and as an expense in 2019, and then suddenly it disappears and it appears as an income in 2020. So it's not actually an income, it's a reversal of an expense that was booked in the previous year. So what we've got is a little bit of kind of funny accounting going on here. I'm not 100% convinced by it. Which is why we like the cash flow. So the cash flow, really, really important, because it helps me to understand what's going on in the business. Okay. Here we have the additional paid in capital. Just worth having a look at this. So this is the additional paid in capital during the year. A lot of stock-based compensation going in there. So this is kind of issue of shares. You've got issues of shares for cash, issues of shares for debt conversion, issues of shares for services. So that's a really interesting one. So in effect, these guys, they're going to their suppliers, they're saying, look, we haven't got any cash, we need to buy your services, we'll give you shares. So these guys are really kind of, so there's an expense there, but they're trying to limit the impact on their cash by funding them by issuing shares. So if you are a shareholder in this business, in effect, you are being diluted fairly rapidly on a almost daily basis. So here is the cash flow statement. So what we see is, because they are issuing all of this stock-based compensation. So, I mentioned this is to staff. In fact, it looks to me like most of this is actually being issued to their suppliers, not to their staff. That makes a little bit more sense. So they're incurring a lot of costs, which is why they're booking this massive loss, but they're funding it through issuing shares and selling shares to their suppliers. Okay. Interestingly enough, here we see the 980 again. So obviously it was if you remember, it was an expense in the previous year. So there it is as an expense, and it comes through as a so an expense, but it doesn't affect the cash flow, so it has a positive effect on cash flow. Here we've booked it as an income. It's not actually physical income, and so we have to deduct it as a negative effect on cash. Okay, so all they're doing is they're kind of reversing, and we're trying to get us a much truer picture. So really our picture of this business is that they're burning $11.5 million, and of that $11.5 million, there's another $11 million of services that they've bought by issuing shares. Okay, and that's really our kind of, so if they weren't issuing shares, it'd be $22 million burn rate, but as it is, it's $11.5 million. Scroll down the rest of the cash flow, not a huge amount going on, so there's no real investment going on. A little bit of, a couple of computers being bought, nothing really exciting. And here we have the this is the repayment of a promissory note. So this is kind of convertible or convertible debt, and really what they've been doing there is that they are in effect issuing shares and basically going debt free. So it looks to me like maybe there's a timing issue here. Maybe they've been some of that interest, don't forget that the interest, they're kind of they had the debt during the year, they're paying the interest, and then they clear it down towards the end of the year. Anyway, what we see now is that they are debt free. They've got a lot of equity there. It looks like there's a form of equity where they have to pay a form of interest, which is why they're booking that in the income statement rather than showing it as dividends, for example, in the movement in equity. So, cash at the end of the period, they've got this, $15 million. Let's just scroll down and just see that. So they've got $15 million, if you remember, in the bank. Here's their $15 million. They are burning $11.5 million net cash from their trading operations. If you ignore if you include the stock that's issued to compensate the suppliers, then they're burning 22 million. So, if the suppliers continue to take shares, then these guys are in effect burning 11.5, and they've got cash to last them for 2021, but not a lot after that. If the suppliers stop taking shares, then suddenly they drop to about 6 months worth of cash, and they have a few problems. So that is the situation right now. It looks to me like there's quite a lot of investors who've got their fingers in the pie. Existing investors are being diluted, and not only the existing investors being diluted, but there's also a lot of people who've invested and are extracting a lot of money through this kind of these interest payments, for example, appearing in the profit and loss account. So there's our summary of quantum computing, and looking at the how the business is performing. Remember, this is looking at the numbers, so let's have a look at the actual financial performance of the business. So here we see the financial performance, and the chart, the share price chart. If we look at it on a max basis, you can see. So when it floated, it bounced all over the place. This looks like a 2008 kind of just before the bust kind of launch there, and it sort of went all the way up, all the way back down again, bounced around a bit, and then basically went to zero. So maybe we should actually look at a kind of, just the last a shorter period to see how the shares have been performing. This is the 5-year marker, and we see 2018 all the way up, bouncing around, then all the way back down again. And if our friend bought in at $2 before 2018 and managed to sell at the top of that spike, then he'd be sitting very happy. So congratulations to you. But timing the market is a mug's game. I'm not saying you can't make money, but you can also lose your shirt. So really what I'm looking at is this a long-term fundamental play? Is this a good investment? It's got a market cap of basically $200 million. So what does that mean for us? Well, it's not earning anything, so there's no PE ratio, there's no sales, so we can't value it on a multiple of sales. There's $15 million in the cash. They're burning $11.5 million. They're going to run out very, very soon, unless they can really deliver the proof of concept, unless they can show how they can monetize this. So from a fundamental analysis, this looks like a very high risk business. Now, remember, it may be that this company has signed a deal. Maybe it has got a client on board. Maybe, maybe they've turned the corner. Maybe something that we don't. And if you do, then please do add it to the comments. So what we see here is the company is trading. It's looking pretty ropey. It hasn't got the strongest financials. It's very dependent on its ability to continue to go to the markets, to be able to continue the story, to be able to continue to raise cash. It's burning that cash relatively quickly. A lot of, maybe there's a lot of investors out there who are going to carry on putting the money behind it. But I'm not convinced that this is for me. This is certainly not an investment for what we call widows and orphans. This is very much part of your play, part of your portfolio, and not part of the bit that's going to fund you through your retirement. So there we have quantum computing. Thank you very much for watching. Please do remember to like, share, subscribe to the channel. Please do add your comments. Please don't say, Ted, you haven't done any of your research on the company. I know I haven't. Okay, this is a 15-minute short, sharp look at the financials of the business. If you know something that we don't, please do share it, and I look forward to seeing you on the next video.